This is LXBN TV, and I'm Colin O'Keefe. Last week, Congress passed the Jumpstart Our Business Startups Act, otherwise known as the Jobs Act. To explain the details of the act, we bring in Muir of DLA Piper, an author on their blog, The Venture Alley, which covers legal issues important to the startup and venture capital industry. Megan, starting with what's probably the most talked about element of the Jobs Act, what can you tell us about what this does for crowdfunding?
The Jobs Act gives you an opportunity to utilize crowdfunding in a sanctioned way, a legally allowed way. The SEC will still need to issue regulations that may end up restricting it quite a bit in terms of the administrative issues that they may impose. What it does is allow people with much lower incomes than would previously have qualified as accredited investors to have the opportunity to invest in private companies. These are often tech companies. Often they're seeking angel funding or venture capital funding, but from an early stage, they might want to approach a broader audience, perhaps over the internet, and utilize small investors to add up to a decent amount of money. There's a $1 million limit in a 12-month period, so we're talking smaller dollar amounts. It's also a percentage of the income cap by the individual. The problem with it is that you could possibly end up with many, many small individual investors who are not really in a position to lose the money. The accredited investor standards of $1 million in net worth, not including your primary residence or relatively high income thresholds, is meant to be a proxy for the ability not only to understand sophisticated financial matters, which of course any income level can, but also that you can afford the risk. So one thing people are concerned about, and I think both the SEC and people in the community, concerned that people who can't afford it will speculate on some of these risky ventures. They're also concerned about scams, where people may have fake companies or sort of temporary companies and use it to raise money over the internet in a much more anonymous way without accountability. So the interesting thing in terms of allowing early stage companies to access funding more easily, which is the point. The point is to allow private companies to get access to funding without as many hoops to jump through, in hopes that will stimulate the economy and as the act is named, create jobs.
And then another important element of the Jobs Act is this so-called IPO on-ramp that it creates, aimed at creating this for emerging growth companies, of course. What can you tell us about this, the IPO on-ramp that's at play here?
What that refers to is it's reducing the administrative and regulatory burden on companies to go public. A couple of interesting features. One interesting feature that hasn't been talked about much is it allows you to file them confidentially. As long as 3 weeks before you start the roadshow to go talk to institutional investors, you make it public. So you could actually file your IPO paperwork with the SEC and amendments and work through your issues with the SEC without your competitors knowing, without them seeing your revenue numbers, your expenses, your losses, and some of the detailed business descriptions that you need to put in the paperwork. Then if you withdraw it, it's sort of no harm, no foul. Your competitors haven't been tipped off to whatever's in there that's sensitive. The other thing it does is reduces the requirement for certain audits, just 2 years instead of 3 years going back historically, and reduces the Sarbanes-Oxley burden for the first 5 years or until you hit $1 billion in revenue. The interesting thing is it's called this IPO on-ramp for emerging companies. It's going to capture most, and most companies who go public in their first few years won't hit the limit, so it actually will apply quite broadly. That's one of the concerns. It's reducing the regulatory burden in areas where recently people thought there were problems, which is why they imposed those burdens in the first place.
I see. That's going to be a very interesting part of it. And then finally, this act moved quickly through Congress, and it's approved by many politicians potentially as an election year demonstration of their commitment to small businesses and entrepreneurialism. But of course, the act isn't without its criticism, including from SEC Chairman Mary Shapiro. What can you tell us about these criticisms, and are they warranted?
There's been criticism about a number of items. One interesting one is the bankers in this emerging company category of companies that go public the bankers' analysts, the analysts who work for the banks, will be able to issue reports in a period where they are not currently allowed to. And they were stopped from doing that because of the concern of hyping the stock. So it's interesting that that's now getting relaxed. The idea is to have equal information for people out in the marketplace as well as institutional investors or the analysts. If they have information and ideas, let's get it out in the public. The big concern is, I think, largely on the crowdfunding or crowdsourcing aspect, that people are worried that scam artists will figure out a way to trick relatively small investors who don't have the net worth to afford to lose it. One thing I want to touch on that I think will actually make the biggest difference in your ordinary venture capital funded company or company that seeks to be venture capital funded at some point is the relaxation of what the 506 offerings. It's a securities law exemption for accredited investors. Mm-hmm. Right now, you need to have some sort of pre-existing relationship with them. They will now allow general solicitation. So, for example, through a portal or one of the services that's set up to do secondary sales of shares, you could have your company provide some information, probably financials and risk information, and accredited investors could come there, review them, and select companies to invest in. That, I think, will open up angel investing to a whole new group of people who are not well connected in your normal tech cities, and will allow companies to do that angel round before and fund themselves to a point where then maybe they're ready to go talk to venture capitalists.
It's going to be very interesting to watch. Of course, crowdfunding has really gotten very popular lately with the popular Kickstarter is very popular for getting projects going. You see a lot of interesting and exciting projects coming out of crowdfunding, so we want to throw legislation behind it, but it'll be interesting to see that when those two combine, the popularity and then the legislation, to see what that impacts. Hopefully it's not too many scams, hopefully it's more economic growth, but you never really know. So it's going to be interesting to watch. Once again, that was Megan Muir of DLA Piper and the Venture Alley. For more on the Jobs Act and legal issues at play in the entrepreneurial community, be sure to check out theventurealley.com. And of course, we have more on the Jobs Act at lxbn.lexblog.com. Thank you, Megan.
Thank you, Colin.